Let me take you back to Tuesday, January 27th, 2026, when the trap was officially set. President Trump made a policy statement that most people dismissed as background noise, suggesting that a weaker dollar would benefit American businesses to boost exports. To the average person, this sounded like boring economics, but traders understood the signal immediately. Because metals are priced in dollars globally, a weak dollar announcement acts as a massive green light for gold and silver to rise. Within hours, hedge funds were shorting the dollar and retail traders were piling into silver by the billions. Everyone was betting on the same outcome, a weak dollar and strong metals. Tuesday was the day the lure was cast, and almost no one realized they were walking directly into a trap. The peak of euphoria. By Thursday, January 29th, the euphoria was total as gold hit $5,600 and silver broke $121 per ounce. Silver had gained 68% in January alone, the strongest monthly gain since 1979. Social media was on fire, with analysts calling for $200 or even $500 silver as inevitable. Retail investors poured a record $171 million into silver trusts in a single day, double the record of the 2021 silver squeeze. The total silver market had grown to $6 trillion, making it larger than Apple or Nvidia. People went to sleep that night, dreaming of early retirement, completely unaware that while they slept, the execution order for their wealth had already been signed. The Friday morning reversal. At 6 in the morning on Friday, January 30th, the screenplay moved to its most lethal phase. A headline hit the wires announcing Kevin Warsh as the pick for the next Federal Reserve Chairman. To a seasoned trader, that name sent ice through their veins, because Warsh is a hard money hawk who fights against easy money and a weak dollar. This was a direct contradiction to the signal sent just 72 hours earlier. The same traders who shorted the dollar on Tuesday were now forced to buy it back, and those who bought metals were forced to sell immediately. Tuesday and Friday saw the same president giving opposite signals, a trap that closed with surgical timing to ensure a forced liquidation event. The margin massacre. The crash was accelerated by a third player that nobody saw coming, the CME Group. Behind the scenes, the exchange had been raising silver margin requirements for 6 weeks, including a 25% jump overnight with no warning. By January 28th, they changed the entire system, resulting in an 80% total increase in the cash required to hold a position. Imagine your landlord raising your rent 80% and giving you only hours to pay or face eviction. Most retail traders did not have that extra cash sitting around, so they were forcibly liquidated. When thousands are forced to sell simultaneously, the price does not just decline, it enters a vertical collapse. This was not the market finding fair value. It was the exchange pulling a trigger. The $10 trillion capitulation. Once the cascade started at 9:30 Friday morning, nothing could stop it as algorithms smelled blood, and stop losses triggered everywhere. Silver crashed from $121 down to $75 in just 6 hours, erasing $46 of value per ounce. Gold saw $900 vanish per ounce, marking the biggest single-day drop in 45 years. One trading desk called it a capitulation event, while others noted $10 trillion was gone in a single session. However, the actual trading data reveals a shocking truth. While 531 tons of silver contracts were traded in Shanghai, 0 tons of physical metal left the vaults. The screen showed chaos, but the physical reality showed a massive position transfer using empty paper, the physical market breakdown. While the paper price was crashing 22% this week, the physical silver market was doing something that makes no sense in a normal economy. Usually, when prices crash, supply increases and product becomes available, but right now you cannot buy physical silver anywhere. The Perth Mint, the United States Mint, and the Royal Mint have all suspended sales or run out of stock. Dealers in India are defaulting on deliveries, taking payments, and failing to send the metal. Even Costco has implemented purchase limits, rationing silver like a scarce survival resource. This is a complete breakdown of the delivery system where the price is crashing while the product is vanishing from existence. The sovereign mint crisis. The evidence of this systemic crisis is everywhere, starting with the Perth Mint, which paused wholesale orders for a full month to clear a massive backlog. They are using rationing language like monthly allocations because they cannot meet the worldwide demand. Meanwhile, the United States Mint suspended sales and then increased prices by 86% overnight once they came back online. They were losing money selling silver eagles at $91 when the real value was much higher, so they simply stopped. When major sovereign mints across multiple continents all experience these issues simultaneously, it is not bad luck. It is a signal that the paper price is a total fiction. The arbitrage gap. There are now 2 silver markets telling completely different stories. The paper market in New York says silver is $84, while the physical market in Shanghai says it is $122. That is a 44% gap for the exact same metal on the same day. In Tokyo, physical silver has sold for as high as $150 an ounce. Furthermore, silver lease rates have exploded to as high as 39%, a panic signal that physical silver is so scarce, holders demand massive premiums just to lend it out. One of these markets is lying to you, the computer screen showing a crash or the empty shelves at the mint. Paper silver is just a promise, and right now those promises are breaking. The Shanghai Vault drain. The most frightening data comes from the Shanghai Futures Exchange, where the silver vaults are being drained at an impossible rate. In a single 24-hour window on January 30th, 27 metric tons of silver were removed from the vaults. That is 870,000 ounces gone in one day from a single exchange. At this rate, the Shanghai vaults could be completely empty in less than 3 weeks. While the global annual demand for silver is over 1 billion ounces, the Shanghai vaults now hold barely 1% of the total. This is a rounding error for the global market, yet no one in the mainstream media is talking about the fact that the East is taking physical delivery while the West sells paper. China's strategic hoarding China knows something the rest of the world is ignoring, which is why they classified silver as a strategic national security resource on January 1st. They have implemented export controls so that no silver leaves their borders, treating it with the same priority as rare earth minerals used in AI and military technology. China already controls 60 to 70% of global silver refining, making them the ultimate gatekeepers. They are moving metal from public warehouses into private storage, hoarding physical silver while the paper market crashes. One side of the world is selling digital derivatives, while the other side is loading actual bars of silver onto trucks. Which side do you think understands the true value of the metal? The Great Wealth Transfer. Nearly all of the aggressive selling this week occurred during U.S. market hours when New York opens and the COMEX dumps digital derivatives. American banks are flooding the paper market with sell orders for silver they do not even have, creating supply out of thin air with a few keystrokes. Meanwhile, buyers in China, Japan, India, and Dubai are buying every physical ounce they can find at a discount. This is a rigged game where the West sells paper and the East buys the prize. Your fear creates their buying opportunity, and your liquidated account becomes their physical accumulation. One side is playing a video game on a screen, while the other side is taking home the real wealth of the world. The repeating script. This is not the first time they have run this script to suppress precious metals. In 1980, they used Silver Rule 7 and a massive interest rate hike to cause an 80% crash. In 2011, they raised margin requirements 5 times in 9 days to cause a 50% destruction that took 13 years to recover from. Now in 2026, they have executed the fastest destruction yet by raising margins 4 times in 6 weeks. Every time silver threatens to expose the weakness of the paper dollar, the same playbook executes. It is a policy used whenever regular people start making real wealth outside the controlled banking system. Once is an accident, twice is a coincidence, but 3 times is a documented script. The 65% monthly signal. In the last 52 years, silver has only gained 65% in a single month 3 times, 1974, 1979, and now January 2026. History shows that this parabolic move can lead to 2 outcomes. In 1979, it led to a blow-off top and a crash that marked a record high for 45 years. In 1974, it led to 5 years of frustrating sideways consolidation before an eventual breakout. Both times, the people who held through the volatility were rewarded, but it required patience that most humans simply do not have. If we follow the 1979 path, we could see one more pump to the $150 zone before a massive top forms. The decision you make in the next 60 days will define your financial outcome for the next decade. The final physical reality. The fundamentals of silver have never been stronger because the world has been in a supply deficit for 5 consecutive years. We have consumed 800 million more ounces than we have mined since 2021, and the bathtub of global reserves is running empty. You cannot print silver, you cannot hack it, and you cannot margin call it out of your safe. The intensity of this attack proves the value of the target. They are protecting the narrative that paper money still works. They expect you to panic and walk away, but the physical reality will eventually win over paper manipulation. Do not be the person who transfers wealth to patient investors by being emotional. The script is exposed, and the real story is never on the surface.